Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
Welcome to your personalized deep dive on property investing in Australia.
You shared with us this article, 10 Financial Property Investing Mistakes Made by Investors. It's a fantastic choice. Like, a lot of people are interested in property investing,
Right.
And for good reason, but, it's also easy to make costly mistakes along the way.
That's right, and this deep dive is about extracting those golden nuggets of wisdom from this article that can really help you avoid those pitfalls.
Exactly. We're not just going to summarize it. We're going to kind of go deeper.
Yeah.
Understand the why behind these mistakes, and most importantly, how to sidestep them on your path to building wealth through property.
Well, let's jump right in. Your article kicks off with a pretty impressive statistic. 57% of Australians build wealth through property. So that's more than half the country, so you're definitely in good company. Yeah. That is a comforting thought. But as the article points out, it's not just about buying any property. It's about having the right financial strategy. They use a really interesting example. A $500,000 property with 8% growth can potentially yield a 60% return on your initial investment if you play your cards right.
That's the power of leverage at work, using borrowed funds to amplify your returns. But it is a double-edged sword, which brings us to the very first mistake that the article highlights: not understanding loan structuring.
Loan structuring, it sounds a bit dry, but I guess it's like building a house. If you have a shaky foundation, the whole thing can come crashing down.
Exactly. And one of the biggest pitfalls in loan structuring is something called cross-collateralization. It's where the bank uses multiple properties you own as security against a single loan.
Okay, the article mentions a cautionary tale about a client in Brisbane who got caught in this trap, losing flexibility because of how their loans were structured. Can you explain why this can be such a problem?
Of course. So think of it this way. You've got a couple of investment properties, and they're all bundled together under one big loan. One property might be doing fantastic, value going up, but another might be lagging behind. With cross-collateralization, you can't easily tap into the equity of that high-performing property because it's tied to the performance of the others. You're essentially stuck.
Oh, so even if I have the equity, the bank might not let me use it freely because of this cross-collateralization thing.
Precisely. And that's just one of the downsides. It also gives the bank more control over your portfolio and can make refinancing or selling individual properties much more complicated.
That makes a lot of sense. What's the alternative? How do I avoid falling into this trap?
The article suggests opting for standalone loans, where each property is secured independently. This gives you much more flexibility and control over your investments in the long run.
Standalone loans. Got it. I'm writing that down. Okay, so we've talked about the importance of loan structuring and avoiding cross-collateralization. What's the next big mistake on the list?
Mistake number 2 is a classic: thinking the bank is your friend.
Uh-huh. Yeah, I think we've all been guilty of that at some point. But, when was the last time your bank manager invited you over for a barbecue?
Exactly.
Probably never.
Banks are businesses at the end of the day. Their primary goal is to make a profit, and that sometimes comes at the expense of the borrower.
Okay, so if I'm going into this property investment game, who can I trust? The article mentions something about property finance brokers. What role do they play in all of this?
A good property finance broker is like a trusted advisor, a shield against the often confusing world of bank loans and financial jargon. They act as your advocate, navigating the lending landscape, comparing different loan products, and finding the best possible deals for you, not the bank.
So it sounds like they can take a lot of the stress and guesswork out of the process. But finding the right broker seems crucial. The article even mentions how valuable they can be for entrepreneurs who might not have traditional income verification. So how do I go about finding a broker who truly understands property investment and has my best interests at heart?
That's a great question. Look for a broker who has a deep understanding of the property market. Ask them about their own investment experience, how they stay up to date on market trends, and their strategies for navigating the complexities of the lending process. A broker who has skin in the game themselves can bring invaluable insights to the table.
So it's about finding someone who speaks my language, who gets the property investment game, and who I feel comfortable trusting with my financial future. That makes a lot of sense. All right, moving on to mistake number 3. Thinking you need to sell to profit. I've definitely heard that misconception before, but the article seems to suggest there's a smarter way.
Absolutely. Selling a property can seem like the obvious way to realize your gains. But it's not always the most strategic move. The Australian tax system actually incentivizes holding on to property for the long term.
Oh, really? Tell me more about that.
Well, if you hold an investment property for at least 12 months, you only have to pay capital gains tax on 50% of the profit. That's a pretty significant advantage right there. Plus, selling comes with a bunch of costs, agent fees, legal fees, marketing costs that can eat into your profits.
So what's the alternative? What should I be doing instead of rushing to sell?
The article points to 2 powerful strategies, refinancing and equity release. As your property value goes up, you can leverage that increased equity without actually selling. Refinancing allows you to access a larger loan amount based on the current value of your property. And equity release lets you tap into that equity directly, often through a line of credit.
Oh, so it's like having a secret weapon to unlock the potential of my property portfolio without having to go through the hassle of selling.
Exactly. It's about thinking long-term, building wealth strategically, and using the power of leverage to your advantage.
This is all starting to make a lot of sense.
Okay.
Okay, we've covered loan structuring, finding the right broker, and the myth of selling to profit. What's the next financial mistake we need to be aware of?
Mistake number 4 is a little scary. Getting the rug pulled out from under you.
Oh, that sounds ominous. What does that even mean in the context of property investing?
It's about hitting a point where banks suddenly view you as high risk, potentially limiting your access to further loans. It can feel like the ground is shifting beneath your feet, especially when you're trying to build momentum with your portfolio.
I can see how that would be a major setback. Why would a bank suddenly decide I'm high risk? What are they looking at?
Interestingly, the article suggests that a common investment strategy, negative gearing, can actually contribute to this perception.
Okay, time for a quick explainer. Negative gearing is when the rental income from a property doesn't cover all the expenses, and you can offset that loss against your other income to reduce your tax burden.
Exactly. And while it has its benefits, especially for high-income earners, banks can see a heavily negatively geared portfolio as a potential red flag. They might worry that you're relying too much on future capital growth to make up for the ongoing losses.
Oh, so it's a bit of a balancing act. I need to be mindful of how much negative gearing I'm taking on.
That's right. The article suggests balancing those negatively geared properties with others that generate positive cash flow. Or with equity manufacturing strategies like property development. This helps mitigate risk and presents a more balanced picture to the lenders.
Diversification is key, even within my property portfolio. I'm getting the message loud and clear. What's the next mistake on our list?
Mistake number 5 is one that might hit close to home for many of us maintaining high credit card limits. It's so easy to fall into the trap of thinking, well, I have the credit, why not use it?
Oh, I know that feeling. It's like having a safety net, but maybe one that can actually backfire.
Precisely. The article uses a pretty alarming statistic. A $5,000 credit card debt could actually reduce your borrowing capacity by a whopping $25,000.
Wow, that's a serious hit. I had no idea credit card debt could have such a dramatic impact on my ability to get loans.
It's all about how lenders perceive risk. Credit cards, especially with high limits, are seen as toxic debt. They signal a potential lack of financial control and discipline, which can make lenders hesitant to lend you large sums of money.
Okay, so what's the takeaway here? What should I be doing to avoid this pitfall?
The article suggests lowering your credit card limits, or even switching to debit cards to demonstrate greater financial control. It might seem like a small step, but it can have a big impact on your borrowing potential and overall financial health.
It's all about building good habits and showing those lenders that we're responsible with our money. Okay, on to mistake number 6, keeping all your financial eggs in one basket. I know people who brag about loyalty perks from their bank, but the article seems to suggest this could be a risky move.
You're right to be cautious. While it might seem convenient to have all your accounts in one place, it gives the bank a complete picture of your financial situation. And remember, they're constantly monitoring your every move.
So it's like giving them all the cards in my hand. You know, every deposit, every withdrawal, every online purchase I make.
Exactly. And this can work against you, especially if you hit a rough patch financially. They might be quick to call in loans or limit your access to credit based on a few minor slip-ups.
That's a bit unsettling. So what's the antidote to this? Should I be spreading my accounts across different banks?
That's a smart strategy. Diversifying your banking relationships creates a degree of privacy and prevents any single institution from having a complete grasp of your financial situation.
Oh, so it's like a financial version of don't put all your eggs in one basket, spread the risk, maintain some privacy, and keep those banks on their toes.
That's a great way to put it. It's all about being proactive and taking control of your financial destiny.
All right, we've covered a lot of ground already, but we're just getting warmed up. What's the next financial mistake we need to watch out for? Mistake number 7 is all about crunching those numbers and taking the emotion out of property investing. It's so easy to get caught up in the excitement of finding a potential property. But the article emphasizes the importance of doing a thorough financial feasibility study before making any big decisions.
Yeah, it's like building a skyscraper without a blueprint. Gut feelings have no place in property investment. You need to understand the numbers inside and out to make informed strategic choices.
Okay, the article talks a lot about yield. Can you break down that concept for me? What does it really mean?
Yeah.
And how do I calculate it accurately?
So yield is essentially the return you can expect on your investment, expressed as a percentage. It takes into account all the costs associated with the property, not just the purchase price. So think acquisition costs, loan costs, ongoing maintenance, council rates, property management fees. It all adds up.
So it's not just about how much rent I'm collecting each month. I need to factor in all the expenses to get a true picture of the property's profitability.
Exactly. There are different ways to calculate yield, but the key is to be comprehensive and realistic. And there are some fantastic tools out there that can help with this, like property investment analysis software. The article specifically mentions PIA, which stands for Property Investment Analysis.
PIA. I'm adding that to my list of things to check out. Okay, so we've learned about yield and the importance of understanding all those costs involved in property investment. What's the next financial mistake we need to avoid?
Mistake number 8 is one that many of us fall prey to, focusing only on interest rates when choosing a loan. It's human nature to gravitate towards the lowest price tag, right?
Yeah, I'm definitely guilty of this. When I see a low interest rate, my eyes light up and I'm ready to sign on the dotted line. But I'm guessing there's more to the story than just that magic number.
Absolutely. Fixating on interest rates can blind you to other crucial features of a loan that can impact your long-term success. The article throws a whole bunch of terms at us: lines of credit, offset accounts, redraw facilities, bank fees, loan terms, repayment holidays, honeymoon rates fixed versus variable rates. It's a lot to digest.
So it sounds like we need a whole separate deep dive just to unpack all of that. But what's the main takeaway for someone like me who tends to get laser focused on that interest rate?
It's about understanding that a loan is not just a number. It's a complex financial instrument with a whole ecosystem of features that can work for you or against you.
So I need to be thinking holistically about the loan and how it fits into my overall investment strategy.
Precisely. And this is another area where a good property finance broker can be invaluable. They can help you navigate all those features, explain the pros and cons of each, and guide you towards a loan that aligns with your specific needs and goals.
It's like having a personal financial translator, someone who can decipher all that jargon and make sure I'm getting the best possible deal, not just the lowest interest rate. Okay, mistake number 9 is a bit counterintuitive. Paying off the mortgage too soon. Isn't that the dream, to be debt-free?
It certainly feels that way, especially in our personal lives. But when it comes to investment properties, things get a little more complex. The article uses a clever analogy to illustrate this point. Think of money as soldiers that should be deployed strategically to capture more prisoners, which represent wealth. Paying off your mortgage is like keeping those soldiers at home when they could be out there conquering new territory.
Oh, I love that analogy. So instead of funneling all my money into paying down debt on an investment property, I should be thinking about how I can leverage that money to acquire more assets and grow my portfolio.
Exactly. The article gives a great example of a woman named Amelia who inherited a large sum of money. She had 2 choices: use it to pay off her existing mortgage or use it as a deposit on another property. She chose the latter, and the results were remarkable. The value of her portfolio grew significantly faster than if she had simply paid down her debt.
Wow, and a compelling argument for the power of leverage. But wait, this strategy applies specifically to investment properties, right? Not to our own homes.
That's an important distinction. The tax deductibility of interest on investment loans changes the game completely. When it comes to your primary residence, paying down that mortgage is usually a wise move. But with investment properties, it's often more strategic to hold on to that debt and use the power of leverage to expand your portfolio.
Got it. Different rules apply depending on the type of property. Okay, on to the final financial mistake we're going to tackle today. Not understanding the 8 secrets to loan approval.
It's not just about income. Lenders look at a whole range of factors to determine your creditworthiness. The article breaks these down into 8 categories: capacity, capital, collateral, economic conditions, character, commitment, credit rating, and common sense.
Wow, that's quite a list. Let's break it down, starting with capacity. I'm guessing that's all about my ability to repay the loan, right? Let's unpack those bonus insights. First up, we have cross-collateralization. Remember we talked about this earlier. The article lists 8 reasons why it's generally a bad idea.
Yes, we did touch upon it, but let's delve a bit deeper. The article paints a rather grim picture of cross-collateralization, and for good reason.
Yeah, from what we discussed before, it seems like it really limits your flexibility and control as an investor.
Precisely. One of the major concerns highlighted is equity lockup. Let's say one of your properties skyrockets in value, but others in the bundle are lagging behind. With cross-collateralization, accessing that equity from that high-performing property can be a real headache.
Yeah, it's like having a winning lottery ticket but not being able to cash it in because it's glued to a bunch of losing tickets.
That's a great analogy. It really emphasizes the frustration and limitations that come with this type of loan structure. You're at the mercy of the bank's policies, which might not align with your own individual investment goals.
And on top of that, there's the inconvenience factor. More paperwork, more fees, more hoops to jump through every time you want to make a move with your portfolio.
It's enough to make even the most seasoned investor pull their hair out.
So to recap cross-collateralization, avoid it like the plague.
Exactly.
Now on to something a little more uplifting. Those sweet, sweet tax deductions. Everyone loves a good tax break, right?
Absolutely. The Australian tax system actually offers some fantastic incentives for property investors, and understanding these can make a huge difference in maximizing your returns.
The article provides a great overview of legitimate expenses that you can deduct to minimize your tax burden. Interest payments on your loans are a big one, right?
Definitely. Those interest payments can add up quickly, so being able to deduct them from your taxable income is a major advantage. It's like getting a little help from the government to offset those costs.
So that's a relief. Now, the article also mentions something called depreciation allowances. And to be honest, that sounds a bit complicated. Can you break that down for me in a way that even I can understand?
Of course. Depreciation is essentially a deduction you can claim for the wear and tear on your investment property over time. So even though property values generally appreciate over the long term, the building itself is considered to depreciate.
Oh, so we're talking about the physical structure of the property, not the land it sits on, like the roof, the walls, the fixtures, that kind of thing.
Exactly. The government allows you to claim a deduction each year to account for the gradual decline in the value of those building components.
Okay, that makes sense.
Okay.
But how do I know how much I can claim? Is there a specific formula or percentage?
There are specific rules and calculations, and they can vary depending on the age of the property and the type of assets you're depreciating. The article gives a helpful example. For a property built after July 1985, you can generally claim a depreciation allowance of 2.5% of the construction costs each year.
2.5%, that's a decent chunk of change. It seems like these depreciation allowances could add up to some serious savings over the life of the investment.
Absolutely. And it's not just the building itself. You can also depreciate certain fixtures and fittings like carpets, blinds, and appliances.
It's like a giant checklist of potential deductions.
Yeah.
Knowing what you can claim can really boost your after-tax returns and make a big difference in your overall profitability.
It's all about playing the game strategically and taking advantage of every legitimate deduction available to you. The article even mentions 2 specific sections of the tax code that relate to depreciation: Division 40 and Division 43.
Division 40 and 43, those sound a bit intimidating.
They might sound complex, but they're essentially just categories within the tax code that outline the rules for claiming depreciation on different types of assets. Division 40 covers plant and equipment, which refers to removable items like carpets, blinds, and appliances, while Division 43 deals with the structural components of the building itself.
So I need to familiarize myself with these divisions to make sure I'm claiming all the deductions I'm entitled to.
Exactly. And a good accountant who specializes in property investment can be a lifesaver in navigating these complexities and ensuring you're maximizing your tax benefits.
That's great advice. And let's not forget about those everyday rental expenses. Things like repairs, cleaning, council rates, property management fees, all those costs associated with keeping the property running smoothly.
Those are all deductible as well. It's important to keep thorough records of all your expenses so you can claim every dollar you're entitled to.
It's like a treasure hunt for deductions. I'm starting to see a whole new side to property investing. And it involves a lot more than just picking a property and hoping for the best.
That's right. It's a multifaceted endeavor that requires careful planning, research, a solid financial strategy, and a willingness to learn and adapt.
Well, we've certainly covered a lot of ground in this deep dive. From avoiding those 10 financial mistakes to understanding the nuances of loan structuring, bank relationships, tax deductions, and even those insider secrets to loan approval, it's been a whirlwind of information.
But hopefully it's been an empowering and enlightening journey. The key takeaway is that knowledge is power. The more you understand the intricacies of property investing, the better equipped you'll be to navigate the market, make informed decisions, and achieve your financial goals.
It's like having a roadmap to navigate the often complex world of property investment. And knowing what not to do is just as important as knowing what to do.
Absolutely. This deep dive has given you a solid foundation, but it's just the beginning of your journey. There are countless resources available to help you continue learning and growing as an investor. Books, articles, podcasts, online courses, property investment seminars. The possibilities are endless.
And don't underestimate the power of connecting with other investors, sharing experiences, and learning from each other's successes and mistakes.
Building a successful property portfolio is a marathon, not a sprint. It's about taking those first steps, learning from your experiences, and constantly seeking to improve your knowledge and strategies.
Now that you have a better understanding of the potential pitfalls and the strategies for success, what's the one action you'll take today to move closer to your property investment dreams?
Will you research different suburbs, connect with a broker, or maybe even attend a property investment seminar? Every journey begins with a single step. What will yours be?
That's such a powerful question to leave our listeners with. It's all about taking action, even if it's just a small step in the right direction.
Remember, the Australian property market offers incredible potential. With the right knowledge, a solid strategy, and a commitment to continuous learning, you can achieve your financial goals and build a brighter future.
Thanks for joining us on this deep dive into the world of property investing. We hope you found it valuable and insightful.
Until next time, happy investing.